Hello, and welcome to our in-depth financial analysis of Monolithic Power Systems, commonly known as MPWR. Today, we're diving into a crucial aspect of financial health, working capital and liquidity. Understanding these two concepts is fundamental for anyone looking to assess a company's short-term solvency, operational efficiency, and overall financial stability. Whether you're an investor, a financial professional, or simply curious about corporate finance, this session will provide valuable insights into how MPWR manages its short-term assets and liabilities. We'll break down complex financial data into understandable segments, offering a clear picture of MPWR's current financial position and its ability to meet immediate obligations. Let's begin our journey into MPWR's working capital and liquidity. Let's start with the basics. What exactly is working capital? Simply put, working capital is the difference between a company's current assets and its current liabilities. It's a critical metric that measures a company's short-term operational liquidity and its ability to cover its short-term obligations with its short-term assets. Positive working capital indicates that a company has sufficient funds to meet its current financial obligations and invest in growth. Conversely, negative working capital might signal potential liquidity issues. We calculate it using a straightforward formula: current assets minus current liabilities. This figure gives us a snapshot of the company's financial health in the immediate future. Building on working capital, liquidity refers to how quickly an asset can be converted into cash without losing significant value. For a business, high liquidity means it can easily meet its short-term financial obligations. This is crucial for day-to-day operations, unexpected expenses, and capitalizing on short-term opportunities. Low liquidity, on the other hand, can lead to financial distress, even for profitable companies, if they can't pay their bills on time. We often distinguish between current liquidity, which focuses on immediate cash conversion, and long-term liquidity, which considers the ease of converting non-current assets. In this analysis, our primary focus will be on current liquidity, specifically MPWR's ability to cover its short-term debts. Now, let's look at the components of MPWR's current assets. These are assets that are expected to be converted into cash or consumed within 1 year. For Monolithic Power Systems, key current assets typically include cash and cash equivalents, which are readily available funds. Accounts receivable represents money owed to MPWR by its customers for goods or services delivered. Lastly, inventory comprises the raw materials, work in progress, and finished goods that MPWR holds for sale. These assets are vital for the company's operational flow and its ability to generate revenue. Understanding the composition and quality of these assets is essential for a thorough working capital and liquidity analysis. Let's consider some illustrative values for context. Next, we examine MPWR's current liabilities. These are obligations that are due within 1 year. For a technology company like MPWR, common current liabilities include accounts payable, which are amounts owed to suppliers for goods and services. Short-term debt covers any borrowings that must be repaid within the next 12 months, and accrued expenses are expenses incurred but not yet paid, such as salaries or utilities. Just like current assets, managing current liabilities effectively is crucial for maintaining a healthy working capital position and ensuring the company can meet its immediate financial commitments without strain. Let's consider some illustrative figures for MPWR's current liabilities. Now let's put our knowledge of current assets and liabilities into practice by calculating MPWR's working capital using our illustrative numbers. Based on our example, MPWR's current assets are $500 million in cash, $300 million in accounts receivable, and $200 million in inventory, totaling $1,000 million. For current liabilities, we have $250 million in accounts payable, $50 million in short-term debt, and $100 million in accrued expenses, amounting to $400 million. Applying the formula, working capital equals current assets of $1,000 million minus current liabilities of $400 million. This gives us a positive working capital of $600 million. A positive $600 million indicates that MPWR has a healthy buffer to manage its short-term operations and obligations, demonstrating good financial strength in the near term. Beyond just the absolute working capital figure, Financial ratios provide deeper insights. The current ratio is a key liquidity metric that assesses a company's ability to cover its short-term liabilities with its short-term assets. It's calculated by dividing current assets by current liabilities. Using our illustrative figures for MPWR, with total current assets of 1,000 million and current liabilities of 400 million, the current ratio would be 1,000 million divided by 400 million, resulting in a ratio of 2.5x. Generally, a current ratio between 1.5x and 2.0x is considered healthy, although this varies by industry. MPWR's illustrative 2.5x suggests a very strong short-term liquidity position, indicating it has ample assets to meet its immediate obligations. This is a positive sign for investors. While the current ratio is useful, the quick ratio, also known as the acid test ratio, provides an even more conservative measure of liquidity. It excludes inventory from current assets because inventory can sometimes be difficult to liquidate quickly or at full value. The formula for the quick ratio is current assets minus inventory divided by current liabilities. Using MPWR's illustrative figures, current assets of 1,000 million minus inventory of 200 million, all divided by current liabilities of 400 million. This gives us 1,000 million minus 200 million divided by 400 million, which simplifies to 800 million divided by 400 million, resulting in a quick ratio of 2.0x. A quick ratio of 1.0x or higher is generally considered good. MPWR's illustrative 2.0x indicates excellent liquidity even without relying on inventory, reinforcing its robust short-term financial health. In summary, our working capital and liquidity analysis using illustrative figures for Monolithic Power Systems suggests a very healthy financial position. MPWR demonstrates strong short-term solvency with a positive working capital of $600 million, a robust current ratio of 2.5x, and an excellent quick ratio of 2.0x. These metrics indicate that MPWR is well equipped to meet its immediate financial obligations and operational needs without relying heavily on selling off inventory. For the future, maintaining this strong liquidity position will be vital for MPWR's continued growth and resilience against economic fluctuations. Potential recommendations include optimizing inventory management further and strategically utilizing its cash reserves for R&D or expansion. This strong foundation should provide confidence to investors and stakeholders regarding MPWR's operational stability and financial management.